Building wealth is a complex and multifaceted endeavor. It necessitates significant effort and meticulous strategic planning. The primary goal is to systematically accumulate assets. This process directly contributes to an increase in net worth. The initial phase demands active engagement and proactive decision-making. It often involves taking calculated risks to generate substantial returns on investments. Scaling wealth involves expanding existing assets and income streams. This process presents a greater challenge than initial wealth accumulation. It necessitates sophisticated strategies for sustained growth. Careful management is crucial to maintain and enhance wealth over time. Defending wealth is a critical stage in financial management. It is frequently identified as a common point of failure for many individuals and entities. This crucial aspect is often overlooked or deprioritized. The focus on wealth growth often overshadows the perceived need for its protection. The necessity of financial protection is often underestimated during stable market conditions. A common perception is that defensive measures are unnecessary until a crisis emerges. This perspective shifts dramatically with an unexpected market downturn or financial crisis. During such events, the absence of protective strategies becomes acutely apparent. This lack of preparedness can lead to significant and avoidable financial losses. The illusion of permanent growth often emerges during specific market conditions. This phenomenon occurs when markets experience consistent upward trends. It is characterized by assets steadily appreciating in value over time. Simultaneously, there is a continuous increase in cash flow. This sustained positive economic trend fosters a sense of security. It also cultivates a high level of confidence among market participants. Periods of economic growth often foster increased market confidence among investors. This rising confidence encourages a natural inclination to undertake greater financial risks. Investors may seek higher returns by venturing into more volatile or speculative assets. Such increased risk-taking can lead to significant overexposure within portfolios. This overexposure creates vulnerability when market conditions inevitably undergo a shift. A sudden downturn can then result in substantial losses due to prior aggressive positioning. Economic cycles are fundamental and unavoidable characteristics of financial systems. These cycles represent the natural ebb and flow of economic activity over time. Historically, periods of economic expansion are consistently observed. These periods of growth are invariably followed by phases of contraction or recession. This sequence forms a predictable and recurring pattern within economies. Understanding these cycles is crucial for economic analysis and policy formulation. Economic booms are characterized by widespread optimism across markets and industries. This positive sentiment encourages investors and businesses to adopt aggressive growth strategies. The prevailing optimistic outlook often leads to an underestimation of potential financial risks. Such periods can result in excessive risk-taking, setting the stage for future market corrections. Unchecked optimism can lead to overconfidence in economic behaviors. This overconfidence causes individuals and institutions to disregard cautionary principles. Such disregard often results in engagement in speculative financial activities. Speculative behaviors introduce significant risks into the financial system. These actions collectively contribute to the creation of a fragile financial environment. A fragile environment is susceptible to instability and potential economic downturns. Overconfidence in financial systems can lead to inherent fragility. This psychological bias often results in the accumulation of wealth without adequate protective measures. Such unprotected wealth becomes highly susceptible to market corrections and economic downturns. The absence of defense mechanisms makes these assets vulnerable to significant value reduction. During periods of economic contraction, this wealth frequently diminishes substantially. Therefore, overconfidence undermines financial stability, leading to considerable losses. Financial freedom is a state of having sufficient wealth to cover living expenses without working. It is often mistakenly perceived as solely the accumulation of a large sum of money or assets. However, true financial freedom extends beyond mere accumulation of wealth. A crucial element is the resilience of that wealth, ensuring its durability over time. Wealth resilience means the ability of financial assets to withstand adverse economic conditions. This resilience is fundamental to maintaining long-term financial stability and true freedom. Achieving true long-term financial independence requires a robust and comprehensive framework. This framework is built upon three essential pillars, each crucial for sustained wealth. These pillars function synergistically, supporting and enhancing one another. Their combined strength is designed to secure financial well-being over extended periods. The framework ensures stability across diverse economic conditions and market fluctuations. It provides a foundational structure for managing and growing assets effectively. Capital protection is a fundamental pillar in financial planning. Its primary objective is the preservation of existing capital. This strategy prioritizes safeguarding wealth over aggressive growth. It acts as a defense mechanism against potential financial losses. The approach ensures the foundational stability of assets. Capital protection is crucial for maintaining long-term financial security. Capital protection involves strategies to safeguard investments from significant losses. A key strategy is avoiding excessive leverage, which can amplify both gains and losses. High leverage increases risk, potentially leading to substantial capital erosion during market downturns. Maintaining sufficient liquidity reserves is another crucial component of capital protection. These reserves cover unforeseen expenses, preventing forced asset sales at unfavorable market prices. Capital protection involves strategic measures to safeguard investments from significant losses. A key element is diversifying investments across various asset classes. Diversification helps mitigate risk by spreading capital across different market segments. Stress testing investments assesses their performance under adverse economic scenarios. Effective control of downside risk ensures the survival and stability of capital. The second pillar of financial planning is income durability. This principle acknowledges that not all passive income streams offer equal stability. Some income sources are vulnerable and may disappear during economic downturns. This highlights the critical need for resilient and stable income alternatives. Income durability emphasizes building a portfolio of robust and reliable income streams. Durable income streams are characterized by their ability to maintain stability over time. A key characteristic is diversification, spreading risk across multiple sources. These income streams are often backed by real assets, providing tangible security. They exhibit strong resistance to economic shifts and market volatility. This inherent resilience ensures their stability even during turbulent periods. Income durability refers to the stability of income streams even amidst market volatility. When income streams are stable, wealth becomes anti-fragile, benefiting from disorder. Anti-fragility means that a system gains strength and improves when exposed to stresses. Economic downturns, instead of causing harm, can strengthen the financial position. This principle allows wealth to grow and adapt positively to unpredictable economic conditions. Structural simplicity is a key principle in financial management. It emphasizes that excessive complexity often leads to wealth destruction. Intricate financial structures with too many moving parts increase vulnerability. Similarly, speculative positions can introduce significant risks to financial stability. The strongest financial systems are characterized by their inherent simplicity. They feature clear and well-defined asset allocation strategies. Automatic reinvestment strategies are integrated to foster consistent growth. Disciplined risk management is a core component, mitigating potential losses. These straightforward approaches are guided by a long-term investment horizon. Simplicity in financial structure is crucial for effective oversight and management. This streamlined approach significantly enhances control over financial operations. Increased control directly reduces the occurrence of costly financial errors. Minimizing mistakes is vital for preserving long-term financial progress and stability. Advanced wealth management involves a significant psychological shift in financial goals. The initial focus on maximizing financial returns gradually evolves. The primary objective transitions to actively protecting personal freedom. This reorientation reflects a deeper understanding of true financial independence. A psychological shift occurs where time and energy gain precedence over financial expansion. Optionality becomes a higher priority than the speed of rapid growth. Wealth is subsequently measured by its maintained stability. The value of wealth is no longer defined by the level of risk taken. Financial independence evolves beyond personal comfort to structural permanence. This involves creating a system that operates without daily personal involvement. Assets within this system function autonomously, requiring no constant supervision. The entire structure is designed for resilience, enduring various economic cycles. This approach ensures long-term stability and sustained financial autonomy. True security does not solely derive from the accumulation of money. Instead, it is built upon a robust and well-structured framework. This essential structure is established through discipline, strengthened over time, and protected by effective risk management. Ultimately, this comprehensive approach ensures that freedom becomes both durable and powerful.